So looks like I'm live here, right? Live. How do I start? Zoom. Website. Zoom. Live. How do I start? Zoom. Website. Zoom. Let's start. Start. Zoom. Website. Zoom. Let's start. Start. Zoom. Website. Hello, everyone. We'll just start in a minute, waiting for a few more people to join us. Yeah, we'll be starting in a minute's time. I'm expecting a few more people to join, and then we'll start. Hello, everyone. Good evening. I welcome you all to this special webinar exclusively for our new customers, for our new subscribers. First of all, thanks a lot for placing your trust on us. We definitely value this a lot. Now, we have been doing our regular webinars, which we do in the first week of every month, in which we talk about our rebalanced portfolio, the new portfolio. But there has been a lot of requests from the new customers as to they don't really understand our product very well, our methodology, or they have a lot of issues which first-time investor would have. So we thought of doing this exclusive webinar, especially for our new subscribers. I am Vivek Sharma. I am the head of investments at ST Advisors and Gulaq. And I'll just take you through the agenda first. Yeah. So I'll just take you through our company, ST Advisors and Gulaq. I'll also be talking about the fund management team, then a portfolio overview, investment methodology, and some more details about how you can stay connected with us. And finally, I'll take the question and answers. So before we begin, I'll just like to take you through these disclaimers. Please have a look at it. Now, whatever we are talking about, nothing of it is investment advice, and investment in securities market are subject to market risks. We have our CIN number also and our registered address also. Okay, So ST Advisors. So ST was founded in 2008 by Sandeep Tyagi. He had this vision of using systematic, data-driven methodologies for investing and for trading. Now, ST has actually been a pioneer in systematic investing in India. It's only now that we hear things like quant investing or algo trading, but we have been doing all of these things for more than 15 years now. We operate in 66 countries, and we have also been awarded NSE Institutional Member of the Year award, and currently we are managing over 1,500 crores. Now, Gulaq is a retail investment advisory arm of ST. About 6-7 years back, we had this vision of using our capabilities, that of data-driven algo strategies, to help our friends, family, and other retail investors. That's how Gulaq was born in 2020. We are SEBI registered investment advisor also and research analyst also. Till now, we have served over 25,000 customers, and we do multi-factor algo-based investment strategy. This is the team. Sandeep Tyagi, as I told you, he's the founder and CEO of ST Advisors. He has done his BTech from IIT Delhi and MBA from Columbia, and he has over 30 years of experience in portfolio management and analytics. I'm Vivek Sharma. I've done my BTech and MTech from IIT Kharagpur, and I have close to 20 years of experience in trading and investment management. And we have Nikhil Dhingra, who has done his master's from IIM Bangalore and also computer science engineering from IIT Delhi. He has over 10 years of experience in investment management. Now, something about our portfolios. We offer large, mid, and small cap portfolios individually. These are focused selections of 15 to 20 stocks. They are sector agnostic and well diversified portfolios. And in this also, we do monthly rebalancing. We went live with these portfolios more recently in December 2024. So it's been about 5-6 months of live track record in these portfolios. We also have our gear-based portfolios, Gear 3 to Gear 6. So Gear 6 is meant for very aggressive investors. We have 100% equity allocation to Gear 6. Gear 5 has 80% equity and 20% debt. So it's slightly more stable than Gear 6. And it's meant for moderate to aggressive investors. Gear 4, again, the equity component reduces further by 20%. So it has 60% equity, 40% debt. And Gear 3 has 40% equity, 60% debt, which is meant for conservative investors. Right? As you can see, as the allocation to equity is coming down, so will the volatility be coming down in these portfolios, and so will be the return expectations. So Gear 6 would be highest volatile as in this list, but also the expected returns from Gear 6 would also be highest. Yeah, so here we have shown the equity and debt allocation. Also the minimum investments in these 4 gears. We have also shown the returns since inception for these gears, and also the benchmark returns. So in all of these, as you can see, we have beaten the benchmark returns by a healthy margin. So Gear 6, we have been live for now about 5 years, and we generated about 20% alpha, annualized alpha. This is over last 5 years, which is a fairly significant alpha, right? And in all the other gears also, if you see Gear 5, 4, 3, every gear we have convincingly beaten the benchmark, and these are live results since going live. Now, Gear 6, primarily I'll be talking mostly about Gear 6 because about 80 to 90% of our customers subscribe to Gear 6 portfolio. As I was talking about, we launched in May 2020, and the CAGR in this has been closer to 45%, whereas the benchmark has grown by about 24%. So about 20-21% of alpha. And every year, barring this specific year where we have some negative alpha, last year was a flattish year for us, but you see every year. So out of last 5 odd years, we have beaten the benchmark in 3 to 4 years. One has been average, and this year has been slightly negative. This has been the year-wise performance across calendar years, last 5 calendar years. This is on the live historical data. This is actually the live results since we went live in May 2020. In this, what we are showing is what is the probability of success. And success for any active fund would be if we are able to beat the benchmark or not, right? So if you see 1 day success, which means on any given day, whether uh, Gear 6 gives you higher returns or Nifty 500 gives you higher returns. So that probability of success is closer to 50%, maybe about 52%. So you have very small edge on a daily basis. But if you hold Gulaq Gear 6 for a month time, then you have about 60% probability of success, which means out of every 10 months, 6 months, Gulaq Gear 6 will perform better, and rest 4 months, the benchmark would be doing better, right? If you increase your holding period to 6 months, in that case, you have a success rate of about 85%. So out of 12 months, let's say, you would have maybe about 9 months, which are in which we do better than the index, and there will be still 3 months where index will do better and we would underperform. Similarly, for 1 year, the success rate goes up to 90%, and for 3 years, it is 100%. So what this means is the longer you hold Gulaq Gear 6, the higher you have a probability of beating the benchmark. Now, there have been cases where even for last 1 year, where people have been holding Gulaq Gear 6 and we haven't really beaten the benchmark, as I showed you. So there is 10% chance where we can underperform out of every 10 years. That's what it means. Out of every 10 years, we'll not be beating the benchmark 1 or 2 years maybe. But the longer you hold, the higher your probability of success becomes. Okay, so let me take you through what is factor investing. Now, I want to explain this using a simple analogy of a student who is preparing for any competitive exam. Now, if let's say there are 1 lakh students, and if I ask you to predict which 5,000 students out of those 1 lakh would be performing the best, how exactly you will go about it? So you look at multiple factors. You'll look at how much of preparation they have done, how much of time they have spent, how strong is their mindset, right? Whether they have had time to rest and recover also, and their examination strategy. These are the multiple things that you will look at. And based on these multiple things, if you have all of this data, based on these multiple things, you'll forecast whether a student would come out in that top 5,000 rank or not. Similarly, factor investing also works for stocks. So we have about 500 stocks in our universe of NSE 500. Out of those 500, we have to predict top 15, 20 that are most likely to work. That is what we are doing in our multi-factor approach. So we have multiple factors that drive a stock's returns. These are very popular factors in the industry. One of the factors is a momentum factor. What that tells you is that any stock which has been in the momentum over past, say, 6 months or 1 year will continue to be with momentum. And that is a huge lot of research has been done. And this works beautifully in in fact, all of the countries. So one is momentum as a factor. Second factor is value. So how undervalued a specific stock is. Based on that, if you select, then what you are doing is you're using value as a factor to select stocks. Then is the growth. Growth could be in terms of, say, revenue, or a growth could be in terms of their earnings per share, or market share, or margins. right? So there are different ways you can actually measure or you can define these multiple factors: momentum, value, growth. There's another factor which is also quite popular, which is low volatility. So what happens in low vol is, if you make a portfolio of stocks which are least volatile, so out of 500 we measure the volatility of each of these and rank it, and you pick the top least volatile stocks, that actually gives you much better returns than index. So this has been seen again historically. uh, this has been another factor which works beautifully, right? Now, if you combine all of these factors, and we have identified almost 130 factors like this which could impact a stock's price. Some of them are, let's say, oil prices. So oil prices impact uh, few sectors much more positively than others, or negatively, right? Or interest rates. These are other factors, or it could be insiders buying and selling. So company's management knows the best about a company. So if a company's management is selling its own stock on a consistent basis, that tells you a very important piece of information, right? It could be index inclusion or exclusion. So any specific stock that gets selected in an index tends to perform well, right? All the index funds and most of the mutual funds will actually go out and buy it. So all of these factors, we have tracking almost 130 factors. If you combine it, it will actually create market returns. So what we are doing in this case is, we have something known as regime estimators. Now, regime estimators mm, trying to figure out which kind of regime we are in the current markets. So regime could be, let's say, put it very simply, it could be rising market, flattish market, or bearish markets. Now, in rising markets, out of those 130 factors, there'll be few factors which will work well. Whereas in a flat market or in a bearish market, there'll be another set of few factors that are likely to perform. And not necessarily that one factor will perform across all three regimes. So for example, momentum as a factor or growth as a factor, these two factors work very well in a rising market. But in a downward market, they tend to lose also a lot. Whereas factors like value, like quality or low vol, these are the factors that work best in the sideways or downwards market. And momentum as a factor, if you use momentum as a factor during downward market, it will tend to lose a lot. So what we are doing is, we are using regime estimators, applying it over the multi-factor library we have of 130 factors, and then we pick only those factors that are likely to work best in the current market regime. So out of 130 factors, we'll just pick only a few which are likely to work in the current markets and ignore all others. Now, using those selected factors, we'll select our stocks. So that is what we are doing in our multi-factor methodology. So the way it will work is, in the rising markets, few factors which are working well, we'll use only those. Whereas in a falling market, we'll use another set of factors to select stocks. And this works very well, as you can see in the results also, right? So that's about our methodology. Next comes that we do a lot to stay connected with our users. It's not only about our Gulaq portfolios, but we try and create content, or we try and educate our investors a lot on multiple other things, be it mutual funds or other issues related to investments, SIPs or PMS, or any issue which investors might face. So we are doing this monthly rebalancing webinar also, which typically happens in the first week of every month, where we talk about our new updated portfolios, we talk about market trends and investment outlook, and also we take Q&A related to our portfolios or any other thing related to investments. We do send out emailers and WhatsApp messages whenever we are holding this webinar. We also publish quite actively blogs on our Gulaq.com website. And these two are some of the blogs that investors liked a lot. One is skill versus luck. So what happens if you are very, very consistent or whether you are lucky in your investments. Another is myopia, which talks about short-termism in investment world. Right. We also do a lot on social media. So we are quite active on Instagram. We upload quite educative reels on Instagram and also on YouTube. These are the handles for our Instagram and YouTube channels. So finally, I'd like to take a few questions. These are the most common questions that we get from new investors. And I'll definitely be happy to take more questions if you have any other questions. So please feel free to send me the questions through the live chat on YouTube. Okay. So the first question we have is, what's the ideal holding period for Gulaq Gear 6? So there's no ideal holding period in the sense that you are actually, when you invest in Gulaq Gears, you are investing in markets, in equity markets. And as we have seen, one thing, the longer you hold, the better your prospects are of beating the market, and also better your prospects are of making money or generating wealth. So I think bare minimum in equity market, and this is not only for Gulaq equity portfolios, but for even for mutual funds, I think you should have at least, definitely not 1 year. I think 2 year is bare minimum. You should invest if you want to make money out of equity markets. And as I said, the longer, the better. If you are investing for less than 2 years, then definitely not put 100% of the money in equity markets. It could be something like a Gulaq Gear 3 or Gear 4, where most of your money is actually into debt and maybe a smaller part is in equity. So the ideal holding period minimum is, I would say, about 2 years, and maximum is as much as you can hold. Next is, how should I set my expectations for returns from Gulaq portfolios? Yeah, so I think one thing is clear that the last 4 or 5 years that we have seen, right from lows of the COVID to highs in September 24, the equity markets gave huge returns. I think the CAGR would be somewhere around 25% or so, which is not really sustainable over longer. So over longer run, what you see is the equity markets deliver about 12 to 15% returns. And the active portfolios like Gulaq Gear 6 will be actually doing very well if we are able to generate, let's say, about 6%. So although we have generated about 20% alpha in the last 5 years, that is the annualized alpha, but I think that's not a reasonable expectation for long term. Reasonable expectation should be, if we are able to beat after costs and fees, if we are able to beat the equity market returns by about 5 to 6%, that I think is a reasonable expectation to have from Gear 6. Firstly, I have also invested in these portfolios, and that is my personal expectation. And that is a reasonable expectation. Although having said that, even that 6% alpha over, say, a longer time frame of 5 years, 10 years is very, very difficult. You'll see that very few funds are able to deliver that kind of alpha over longer. But I would expect about that really, and uh, would not give too much of importance to the alpha that we have generated in the last 5 years. Okay. What is Gulaq's rebalancing process? So what we do is, at the end of every month, we take all the new data that has come in. So it's a mix of, when I spoke about the factors earlier, those factors are mix of technical factors, which are price and volume dependent. Then we have fundamental factors. So a company's balance sheet, their profit loss statement, all of that comes under fundamental factors. And we also do have a few macroeconomic factors. We take all of this into account when we are rebalancing. During rebalancing, we will score each and every stock on all of these factors. And then we also see that what are the factors that are likely to work best in the current market scenario. We'll use only those factors. On the basis of that, we'll come up with a consolidated score and use that scoring to pick our stocks for the next month. Now this happens every month. Every month we are rebalancing our portfolio. Those updates should be on your small case app. You'll get the notification. And I've seen few people do miss out on rebalances. I think that is one you shouldn't do. Ideally, you should be able to do it that very day, or at worst, if you are unable to do, maybe one day. Mm, One day delay is also fine, but if you delay by too much, then your returns are not going to match the returns that you see on small case platform. So ideally first or second day, if you rebalance, that's good. Should I do SIP or lump sum? I think this is a very, very common question that we get. Lump sum works better historically if you just look at the data. If you just leave apart all the other things, look at the data, lump sum works better. When I say better, investing is always a game of probability. It's never 100% certain, right? So it's always a game of probabilities. What's the probability of market going up tomorrow? It's not 100%, it's not zero. It's somewhere in the middle. So when you invest via lump sum money, the probability of you doing better is about two-thirds, 67%, whereas SIP works better in 33% of the cases. So that's what data tells us. Data tells us lump sum is a better form of investment. But when I talk to investors, I think there's another aspect, which is the emotional aspect, or which is easier to do, which is easier for you to handle. That is clear that SIP for most investors is a better thing to do emotionally, because what they really are concerned about is, if I do my investment today and if market crashes, that is something that most investors fear, and that is something they want to avoid at any cost. So there are pros and cons of both SIP and lump sum, but emotionally for most investors, doing SIP is a much better strategy than lump sum. Why do my personal returns differ from Gulaq published performance? So now this happens quite a bit. This happens a lot. And why? There could be multiple reasons. As I told you, one of the reasons would be your rebalancing time. So if you're not rebalancing on time, then your returns would definitely differ. Even if you're rebalancing on time, somebody who has rebalanced in morning versus somebody who rebalanced towards the end of market would get different fill prices. So their returns would also differ a bit. So that is one thing. Second could also be the size of your account. So if your size is smaller, say about 2, 3, 4, 5 lakh, you really won't get too much of slippages. Now, slippages, when you uh, when you actually execute an order in the market, it is showing you that the uh, price of that stock is 100. But if you go and buy or sell a stock, that price actually would differ from 100. Now, that difference from the market price and the price that you get is called slippages. Now, normally for a smaller account, these slippages cost is lower. For accounts like 15 lakh, 20 lakh, 50 lakh, those slippages are higher, right? So second reason for the returns difference would also be these slippages. And third reason is your brokerage cost. So if you are on a full service broker, you'll obviously be paying much higher cost as compared to if someone who is on a discount broker, right? So the returns would differ also in that case. The final thing is also that if somebody is doing SIP, because on small case, the way they show returns is point to point returns. They do not really show the SIP returns. So if you are doing SIP or doing some top ups or some withdrawals, then in that case, uh, your total returns would not really be measured accurately by CAGR. Rather, they would be by XIRR. So there's a different way to calculate, but if you actually won't be able to compare XIRR to the returns that are displayed, because the returns that are displayed on the site are based on cumulative growth rate. Right? So these are multiple reasons why your returns would differ. Typically, what we have seen is a loss of about 2 to 3% from the published returns because of the slippages because of the brokerages. So you won't be getting exactly that. You'll be getting about 2 to 3% lower. And that's what I told you, that after your costs, slippages, fees, if you are able to deliver about 5 to 6% alpha, that's a very good alpha. So yeah, I think that's about it from my side. I would now, so these are phone numbers and support IDs. If you have any issues, you can get in touch with us through calling us or emailing us. But I'm here right now, happy to take any questions that you might have. Okay. Now I got one question from Aman. The question is, I am a subscriber of Gulaq Small Cap. What could be estimated 10-year CAGR of Gulaq Small Cap? Now, Aman, I can definitely show you the historical back-tested results, because we only have 5 to 6 months of track record. So that track record is not really enough to make any conclusion. But we have published the historical track record of our Gulaq market cap based portfolios. You can go to gulaq.com and on the blog section and check out that specific blog. That is one thing that you can do. But another thing that I think would also be, because even in that, if you see, our returns would be very, very high. I think that is something of the order of 35 to 40%. I really won't expect that much. So I'm just opening that blog once. Let me see if I can share it with you right now. Okay, yeah. So here is the blog on gulaq.com/blog. The blog's name is Gulaq MCAP Portfolios. Now, if we look at these portfolios, these are the Nifty returns and these are the Gulaq returns. So overall, if you see small cap, so small cap has, this is the back-tested performance. The performance is from Jan 2012 to October 24, so roughly 12 years. And we have taken assumption of transaction cost slippages at a 1 lakh portfolio size. So if you see overall, Gulaq small cap is expected to give, I won't say expected, but at least as per backtest, it gave 38%, whereas the benchmark gave about 21%. Normally, what happens is no strategy is able to perform exactly. There is some gap or leakage from this. Now, this leakage could be anything. I really don't have anything, but I think if large caps or overall market is growing at about 12 to 15%, I would expect small cap to grow at about, say, 18%. And any good active fund, small cap fund, if it's able to beat by about 5 to 6%, that's a very healthy return. So I would say about 24, 25% should be a very solid performance if we are able to deliver that, right? So that would be my expectation, really. Okay, so we do have another question. SK is asking, why do you think Gear 6 is underperforming the Nifty 500 and Nifty 50 on most days for even the past 6 months, let alone the past year entirety? Do you have an analysis on that? Would love to see. So SK, we don't really have analysis at this moment, but it's very hard to tell why exactly you are underperforming. See, most of these strategies, what happens is uh, there's no strategy, first of all, which would outperform all the time, right? So you consider the best investor. Warren Buffett is considered the best investor in the world. If you look at his track record, it's not only there are years, many years where he has underperformed. There has been even a stretch of 5 years or longer where he has underperformed the market, right? But overall, he delivers because his strategy works most of the time, not all the time. And that's what happens with most of the good active managers, that on any 10-year time frame, if they've beaten the index or the benchmark, uh, roughly there'll be 6, 7 years where they have done well, but they would have been definitely 2, 3 years period where they strategy was not conducive to the market conditions at that point of time. And same is the result with any quant strategy. Uh, so as you see, last 5 years, about 3 years, we did very well. 1 year was kind of average and 1 year slightly lower. But the good thing, I think, the way I see it, the good thing here is the kind of alpha, if we have performed well, the kind of alpha that we have given is about of the order of about 15-20%. Whereas when we did bad, like this year, we are underperforming. We have underperformed by about maybe 5-6% on net basis. On gross basis, it's even smaller, but on net basis. So it's just that uh, over long run, the strategies that you have to select stocks, the markets are not conducive all the time. There are times where the markets are not conducive to your style of picking stocks, and that's why you have that underperformance. It's very very common, uh, and not common, but I think certainty that you will underperform from time to time. That is a given, right? So yeah, that's what I have to say. So Somadipta is asking, are quant strategy underperform in falling market? I won't really say that quant strategies underperform in the falling market, because one of the statistics that I don't have here is that of drawdown, maximum drawdown. So if you look at our drawdowns, earlier there have been cases in the last 5 years only I'm talking about. Earlier there have been cases where we have in the bear markets where we have seen less drawdowns than the benchmark, and there have been cases where we have seen more drawdowns. But one thing has been clear, that whenever these drawdowns have occurred, we have recovered at a much faster pace. Now this time we really haven't recovered because markets are still below the highs. But at least in previous cases, if the market have taken, let's say, 6 months to recover, we have recovered in 4 months, and next 2 months we have made some alpha. So that has been one consistent theme. It's yet to be seen what happens this specific time. But that is one very consistent theme that I have observed, that we have been able to recover. The time that we take to recover has been faster, at least in the past few drawdowns that we have seen in the live track record. Okay, I think those are the questions. If you have any more questions, I'll be happy to spend some more time taking those questions. Okay, SK is written, thank you for the wonderful answer. I do have a slightly non-investment related question. What do you think happened in Nifty? The 200 to 300 point fall and rise in couple of minutes. Now, SK, I don't really know which specific. Acha, yesterday. It's anybody's guess. So in our firm, what we do is also a lot of proprietary trading, where we are trading high frequency strategies with our company's capital. So I do keep a track of what is happening in the futures options market. One of the things that is happening, I don't know frankly whether that was the case, but one of the things that has been happening on expiry days. So yesterday was Sensex expiry. What has been happening on expiry days is huge movement in a very short time frame, like what you have mentioned. In very short time frame, there's been huge movement, and uh, I don't know, frankly, whether that is intentional. Somebody is trying to game the market, primarily options market, but that's a trend we have seen, that during the expiry days there is slightly higher volatility. SEBI is also looking into this, doing some investigations, but we really don't know what is causing those movements. But that could be one of the things that is impacting the market, especially on expiry days. But having said that, see, if we are longer term investors, these smaller movements, not intraday only, but even day to day or week to week movements, I think we have to develop a mindset to really ignore these kind of movements. It's very, very hard to predict what is going to happen in the short run. And not only hard, it's not of much use really, right? The best investors are able to stay invested despite the noise. So we have seen, I think last year when Russia-Ukraine war started, there was a lot of negativity. Even world over markets went down, even Indian markets went down, but uh, they really recovered very fast. Same thing happened past couple of weeks with India-Pakistan issue. We saw markets correct and again go back. So these kind of things will keep on happening. You really can't predict what will happen in the short run. What we can predict is definitely if you have a slightly longer time frame, let's say 5 years or even better 10 years, uh, you can say there's a very, very high certainty that markets will be much, much more higher than where they are. We'll definitely see corrections of 5, 10% or even 15, 20, 25%. But even after those corrections, markets will be very, very high from where they are currently. And that's what we've got to, as investors, we've got to focus on the longer term and try and ignore all the noise that is there in the markets. Yeah. Okay. Um, I'll wait for a minute or two, see if there are any more questions. Okay, Mehul is asking why the same stocks bought after they are sold during rebalancing. Okay, and there's another question by Shumam, which I'll take after this. So, Mehul, what could happen definitely is, see, um, the selection criteria, whether we are buying or selling, all of this is rule based. So we have designed those rules looking at patterns, historical patterns of last 10, 12 years of data. Mm, and uh, these are all rule based. I do not have my own biases or my own view as to a specific stock should do well or sector should do well. What is happening in the past couple of months is we get a buy signal because there is a lot of volatility in the markets. Next month, we might see uh, reduction in score because of which we are getting a sell signal, and another month, they again the score would increase and we'll get a buy signal. So there's a lot of churning, and we might lose at times in this churning. Uh, but in quant strategies, I think this is the nature of quant strategies that quant strategies typically have very high churn rate. You might see it as a bug that it has a high churn rate. Frankly, this is a feature. And let me explain why. Because these quant strategies take high frequency data. So on a daily basis, markets are changing, and we are able to analyze that data because we use computer programs to analyze this tons of data at a very fast pace, which humans can't do, right? And because we are able to analyze this fast changing data, we are able to take our decisions faster. Uh, Most of the time, it works in our favor, right? But there'll be times where it works against us. As you mentioned, there'll be few stocks where we would have bought at high, sold at low, and again bought at high. So there'll be few times and few stocks where it will work against us, this specific strategy, this rule-based strategy. But most of the time, it will work in our favor, that we are able to act faster, right? So I see it as a feature, but when we do look at the churn rate, it usually is higher. But I think that's a part of the system, and we've got to trust the system because this system has produced results in not only in the back test of last 12, 15 years, but also in the live markets. And there'll be times where we underperform. Last 1 year or so has been that time where we have underperformed, but we have got to trust the system that over long run it will pick more winners than losers. There will definitely be losers, but the expectation is we will be able to pick using this rule-based system. We'll be able to pick higher number of winners than losers. Okay, Shubham Sharma, invest with 1 lakh with 500,000 SIP is good or bad for 2 years. So Shubham, I think one thing is good is you mentioned 2 years. So that's the bare minimum time you should stay invested in equity markets, not only Gear 6. So I think your time frame is decent. The longer it is, the better. Now, when you are asking invest with 1 lakh 5,000 SIP, I don't see any problem here. But I think whether it is good or bad, I'll only be able to tell you. I can't tell you because this is not a generic answer. It's dependent on your, first of all, risk profile, how much risk, how much you've already invested in equity. So if your equity is already close to 100% and based on your risk profile, you really cannot afford to stay invested 100% in the equity, then this would be a bad decision. Then you need to, let's say, stay out of equity or reduce equity allocation and move to debt. Now, you'll need to decide whether it's Gear 6 or which specific equity investment that you need to move out. So there are multiple other things which using which I'll be able to tell whether it's a good or bad decision. But just that your return here, I don't see any problem with this statement. I think it is good. That's the only thing. One more thing, Shubham, I'd like to highlight here is because of our fees, which is closer to 6,000 per year. So for you, if you invested 1 lakh, it comes out to be 6% of your overall portfolio when you start with 1 lakh. So that 6% fees is definitely on the higher side. Ideally, your fees should be 2% or lower. And 2% means your total AUM should be closer to 3 lakh or so. So I think that is one thing that I'd like to highlight here, that you're paying, because ours is a fixed fee structure. The higher you invest, the better it will be for you as an investor. So that's the only thing that I see which is bad, but the rest, I think it's good. Yeah. Next is we can avoid charges, Mehul. Mehul, I don't really understand what you've written about we can avoid charges. If you can elaborate on that. Next is Aman has written, one good thing about you people is that you don't launch too many small cases. Many small case managers launch too many, which creates confusion. So Aman, I agree that that's what our investment philosophy is, that you as an investor, I have 130 micro strategies that I'm using. I can actually create 130 portfolios and they'll sell better because किसी ना किसी को कुछ ना कुछ तो बढ़िया लगेगा ही. But I think our purpose here is to simplify investments for you, for investors, and we'll only be able to do it if we keep a very small group of portfolios so that you don't need to select which portfolio I should invest in. If there are too many portfolios, that creates a huge confusion. And that's what we bear in mind. And that's what we have tried to do in past 5 years. So thank you. Thanks a lot. Vikas has written, I am an STPMS investor. Are you planning a webinar for PMS investors? So Vikas, yes, we do keep holding PMS webinars from time to time, but I do agree it's been some time that we have had a webinar for PMS. So we'll definitely do plan a PMS webinar in the near future. Can I ask my question in this forum, Vikas? Thank you. So yeah, Vikas, you can ask if you have a PMS related question. I'm happy to answer right now as well. So for the other investors, PMS are portfolio management schemes where we take in money. The minimum investment is 50 lakh. We run a similar strategy, but the portfolio is much more diversified under PMS. The name is Long Alpha. And in PMS, we do rebalance the portfolios on customers' behalf. So we take care of end-to-end execution and all the rebalancing as well. Like on small case platform, you need to go and click and you need to rebalance yourself. In PMS, we will rebalance. So because I'm happy to take if you have any specific question related to PMS. or other questions also if you guys have related to Gulaq portfolios. Okay, I'll just yeah. I started in November, and last 6 months, Gulaq Small Cases has outperformed PMS. Yes, could be possible. So, because I think not only in 6 months, our expectation is that over longer run, Gulaq Gear 6 would do slightly better than PMS. As per the historical data, I think the difference is about 2-3%, which is not big, but which is not too small also. But at the same time, what you've got to consider is, first of all, whenever we are judging any strategy, 6 months is a very short period. You should take it longer data. That is one thing. And secondly, if you were to invest 50 lakhs in Gulaq Gear 6, there'll be huge slippages. And secondly, the volatility. The volatility of our Gulaq portfolios is much more higher than PMS, because PMS is very diversified. That is one thing. So volatility wise, Gulaq Gear 6 is higher. And also, if you actually invest 50 lakhs in Gulaq Gear 6 and use all case for rebalancing, you'll have huge slippages. So net, after paying those slippages and brokerage cost, you will actually, I don't think you will end up above the PMS. It will be more or less in line, or maybe could be even lower also, right? So Gulaq Gear 6 does not take into account the slippages and the brokerage charges, whereas the PMS, what the results that you see are after slippages and brokerage charges. So it's not a like-to-like comparison, but I think this could happen over short run or even slightly longer run. There could be times where Gulaq Gear 6 outperforms, but then there'll be other times when PMS outperforms Gulaq Gear 6. Yeah. So yeah, that's what it is. Okay. So last few questions, if you guys have any, I'm happy to take. Yeah. So because I know last couple of months, I am an investor myself in RPMS. I know there has been more volatility in PMS. That is something that we are actively looking at. That how exactly to reduce that volatility. Although over longer run, the volatility is lower in PMS, but past couple of months the volatility has been higher, and we have been researching a lot to figure out exactly how we can reduce this volatility as well. So over long run also you'll see much lower volatility, but we have been researching and we are trying to figure out exactly how we can reduce it further. So that's what I can share at the moment. But definitely in the PMS webinar that we'll hold, we'll discuss it in more detail as to what has happened in the recent past and what we are doing to improve it. Okay, I think thank you. That's about it. Thanks a lot. Thank you everyone for subscribing to our portfolios and also taking out time to attend this webinar. And I look forward to seeing you even in the monthly webinars that happen in the first week of every month. Thanks a lot, everyone. Thank you.